Welcome to our webcast. Because this is a webcast taking place on Halloween, we would be remiss if we did not acknowledge that. And so today you are joining us for the CFO Playbook on Strategy, how to take the fear out of accelerating your company's transition to the new revenue recognition standard. Brought to you by Argyle, with support from the sponsor of our webcast, Workday. I'm Joe Fleischer. I'll be your moderator. Now, before we get started, I'd like to cover a few features of the console that you are viewing. I'd note that on the left-hand side of your console, you will be able to view slides and polling questions, and in a moment we'll go over how to respond to polls. I'd also point out that you will be able to download a PDF document that comprises slides from our webcast by clicking on the link to download slides, and that link is located in the resource list icon area within your console. Now, although we will plan to dedicate the latter portion of our webcast to addressing your questions, we invite you to type your questions and comments at any time during our webcast in the Q&A area of your console. Those who attend our live webcast will have the opportunity to earn a certificate representing one continuing professional education or CPE credit. To be eligible, we ask that you respond to all three polling questions we will intersperse throughout our webcast. When we display a polling question, you are welcome to select the radio button that corresponds to your answer and then click on the Submit button so we can record your response. After we have posed our third of three polling questions, if you have answered all three during the course of our live webcast, you will be able to click on an icon to download a certificate that will be located in the certification section of your console. If you're not able to retrieve your certificate and you are eligible during the live webcast, you will also be able to retrieve your certificate when the webcast is available on demand within the webcast section of CFO.com later this week. I'm very pleased to tell you about our very distinguished guests who are joining us, Kristen Bauer of Deloitte, as well as Leah Albach of Deloitte, George Victor with Giambalvo Stalzer and Company, and Cecil Nazareth of IFRS Partners. And just very quick background about our very distinguished guests. Kristen Bauer specializes in technical accounting at Deloitte's national office, serving as a consultation resource to engagement teams serving a broad range of industries, and specializes in revenue recognition and leases, and has extensive experience in current implementation efforts. And prior to rejoining Deloitte in 2014, she was a practice fellow at the Financial Accounting Standards Board. Many of you know this as FASB from 2010 to 2014, and during her time at FASB, she led the FASB's revenue recognition project team that developed the final revenue standard. And she was also a key contributor to the project team responsible for improving the financial reporting of leases, ultimately resulting in ASC 842 and IFRS 16. Before her fellowship with FASB, she served in various roles in Deloitte's national office and as a consultation resource assisted engagement teams with addressing issues related to restatements, assessments of materiality, management integrity, possible fraud and illegal acts, and client continuance. And she began her career in Deloitte's Chicago office and served clients in that market for 10 years. We have the pleasure of hearing perspective as well from Leah Albach, Managing Director, Deloitte Risk and Financial Advisory. She focuses on technology, media, and telecommunications industries for Deloitte & Touche LLP and has more than 15 years of experience providing advisory and assurance services to startup, midsize, and large multinational companies in the U.S. and Europe. She specializes in helping clients solve technical issues and operational accounting matters in areas that include revenue recognition, leases, business combinations, consolidations, and employee benefits. George Victor, partner with Giambalvo Stalzer and Company, is the partner in charge of quality control with Giambalvo Stalzer and Company, certified public accountants in Great River, New York, and he is responsible for formulating the firm's accounting and auditing policies, monitoring compliance with professional regulatory standards, and oversight of the firm's professional education program. And joining us, we have Cecil Nazareth, managing partner with IFRS Partners, based in Connecticut. IFRS Partners specializes in IFRS education, training, and consultation and conversion, and its clients include CPA firms as well as small and medium-sized businesses, including subsidiaries of foreign companies. Now, what I'd like to do is pose the very first of our questions to our very distinguished panel, and what we will do is then indicate to whom we're going to direct the questions. But first, what I'd like to do is ask, what would you characterize, or I think we're going to start with Leah from Deloitte. Leah, what would you characterize as CFO's top priorities at this time as they prepare their companies to adopt the new revenue recognition standard? Leah, why don't we start with you, and then we'll hear some perspective as well from George and Cecil.
Sure. So I'm going to answer that question from a perspective of companies that's going to be impacted on a limited basis and companies who will be impacted on a significant basis. So I would say, in my view, that CFOs of companies that are going to be impacted on a limited basis should focus on a few things. They should first make sure that there are no surprises, that you're comfortable, your auditors are comfortable with that, and about your analysis and your position papers. I would also say make sure that you have taken your audit committees through your analysis and get their input. And lastly, I would say make sure that you don't underestimate disclosures. Under the new standard, the disclosures are expected to be more significantly. So you want to make sure that you have, no data limitations, and that you have that under control. From companies that are going to be significantly impacted by the new standard, I would say, as a CFO, I would make sure that all the organizations within the company are aware of the standard and are also known where the differences are. So what I mean by HR, IT, the FP&A organization, and investor relations. And let me give you an example. For example, in the technology sector, under the current guidance, some of you can recognize your licenses revenue over time. And under the current standard, that might not be applicable, and you may have to recognize at a point in time. And that has big implications for your organization. That has implications for investor relations because they have to be able to explain this change to the street. This has implications for HR because your compensation plans may have to change. Your finance organization needs to be aware of that because your forecast will change. And obviously, your IT organization needs to be aware of that because you may have to implement new systems and collect more data. So I would say that's one of the key priorities for CFOs. Other suggestions I would say try to minimize the disruption on the rest of the organization. Your business does have to continue forward. And lastly, I would say keep a close eye on your implementation costs because those can rise very significantly.
Well, thank you very much, Leah. And we're now going to hear additional perspective in response to this question. First from George and then from Cecil. And George, I know you have some recommendations on how departments can collaborate, including the departments Leah had mentioned. And then Cecil, I think it would be valuable if you were to recap for members of our audience the 5 stages of revenue recognition. But before we get to that, George, I'd just love to hear your perspective on how organizations can make sure that various departments collaborate with finance in preparing to implement the new revenue recognition standard.
Sure. Well, following up on some of Leah's comments, which were very helpful, just some other practical considerations for the CFO to consider in their companies. Number one, knowledge is key. Very important to ensure that everybody involved in the various affected departments is educated on the new standard. So there's going to be significant training that may need to be planned ahead of time at various levels for different individuals. Some people may need some more basic training just to get an understanding of the standard without going into too much detail or too much complexity. Other people who are more involved in the planning and the directing are going to need more in-depth training on the intricacies of the new standard. Secondly, coordination throughout this process. Make sure that the management gathers the appropriate information regarding the changes that are required that could involve quite a number of facets, some to include, sales contracts, vendors agreements, accounting systems, and financial reporting processes, among others. So there's a fair bit of coordination that needs to be involved here, and someone needs to be responsible for it in order to make sure that you can hold people accountable so that it gets done. And the last one I'd say is really the design and the architecture of this process. Building a model or building a template based on the company's existing data to make sure that the processes are fitting in to the standard the way it should be designed, not on its own system, but the way following the prescriptive of the standards. And those are my thoughts on that.
Thank you very much, George. And Cecil, given that it is always good for members of our audience to hear a recap of not only what they need to know in the short term, but just as a reminder, what the key stages of revenue recognition are that they have to keep in mind. So Cecil, want to give you the opportunity to contribute your perspective, including recap for members of our audience or members of our audience who may not be familiar with regard to the key stages, the 5 stages of revenue recognition.
Yeah, thank you very much. There are 5 stages basically, and if you haven't heard of this, let's just recap. One is identify a contract. Second, identify performance obligations. Number 3, determine transaction price. Allocate the transaction price and recognize revenue. So those are the 5 stages. And I work with a lot of multinational companies and more international and some more private. But I find that this is a really good standard, for the past 5 or 10 years. I'd say it is a major change to our accounting standards. The good news when I work with international companies is they started complying with the standard, and I feel there'll be worldwide acceptance. I think that to me is a big success. One size fits all, so no matter which country or which company you're working with, you have the same 5 you're going to live by. And that eliminates all the industry guidance and a lot of other stuff that was impeding our comparative financials. I'm also a professor, so I teach global accounting, and I will be honest with you, it's a very significant piece of accounting literature that has impacted the profession, and I'd say comparability of financial statements across the globe.
Thank you very much, Cecil. We're going to transition to our first of 3 polling questions, and then we'll continue our discussion. First of 3 polling questions ask attendees to indicate the extent to which you agree with the statement. My finance team currently has enough time and resources to implement the new revenue recognition standard. What you're welcome to do is select the radio button that corresponds to your answer and then click on the submit button so we can record your response. From top to bottom, the choices are strongly agree, agree, disagree, strongly disagree, or I don't know. And we do ask that you select the radio button that corresponds to your answer and then click on the submit button so we can record the extent to which you agree or disagree with the statement. My finance team currently has enough time and resources to implement the new revenue recognition standard. And what we will do is give you just a few more seconds to respond. We'll then briefly summarize your responses, and then we will continue our discussion. And so far, what we can readily see, and this may not necessarily come as a shock, and actually this is somewhat reassuring indeed, that a majority at the very least agree. There's not necessarily strong agreement, so that's why many of you are here. And I will acknowledge that roughly a quarter of respondents at the very least disagree, if not strongly disagree. So this is definitely a great occasion for us to get together. And when we talk about finance team currently having enough time and resources, this certainly leads into our next question. And what I'm going to do is pose this question, which is, what are the deadlines to comply with the new standard? What should finance leaders keep in mind if their organizations need to implement new revenue recognition rules within an accelerated time frame? And what I want to do now is direct the question first to Kristen of Deloitte, and then Cecil, and then George.
Sure. Thanks, Joe. I wanted to maybe just walk through, and the slide does show the mandatory effective date, and this is for U.S. GAAP filers as well as IFRS. Each of the standards write it a little bit differently, but assuming that most are following U.S. GAAP, it's actually written as annual reporting periods beginning after December 15th, 17, including interim periods within that reporting period. And so as you see on the slide, for a typical public company calendar year end, that would be effective 1/1/18, which as you readily will see, that's right around the corner, about 60 days from now. The standard does allow for two different approaches to adopt, both retrospective approaches, which effectively means you need to look at all of your contracts and compare the old guidance to the new guidance and show a cumulative effect adjustment of adopting that new standard, either in the modified retrospective as of the date of adoption, so the cumulative effect adjustment as of 1/1/18, or if you're doing the full retrospective approach, that would go back to the earliest comparative period, which typically would be 1/1/16. In terms of an accelerated time frame, I think this obviously is dependent upon whether or not you've been actively working through an implementation plan to date, and this is kind of the tail end of that implementation plan, or if the last polling question indicated where our audience is, it may suggest that there are a lot of activity that still needs to be accomplished by companies. And so I think some of the next questions as we walk through will give you some perspective and thoughts about the breadth of this new standard, which I would agree with Cecil in terms of the scale of this new standard. It's not isolated to one part of the organization, but rather is quite significant. And private companies, if you're one of those, there is 1 year deferral. So for those companies, they're not required to adopt until 1/1/19. And in fact, you're not required to adopt in an interim period of that year. So you could wait until the end of the year to adopt if you're a private company. But flipping back to public companies, one other part that is on this slide that I would really encourage those to keep focused on is people are focused today on 1231 and the Form 10K that will go with this year end and the SAB 74 disclosures that will accompany that public filing if you're a public company, describing the effect or the anticipated effect of the adoption. And then the first quarter will come very quickly thereafter. And because of the SEC rules, the first quarter 10Q will actually require a full set of disclosures. And Leah mentioned this when she talked just on the last question. The package of disclosures is quite comprehensive and will require quite a bit of work. And so don't think that you've got all the way until the end of the year and filing the 10K for 18 to get all of the disclosures pulled together. That's going to come right around the first quarter, and the issuance, again, if you're a calendar year company, for the March 31 first quarter. So let me pause there, and I'm sure Cecil and George will have something to share with the audience on this slide as well.
Thank you very much, Kristen. And Cecil, I know you've highlighted, as did Kristen, the retrospective versus modified retrospective. Just wanted to give you an opportunity to comment there. And then, George, I'd like to hear your perspective as well.
Yeah, quickly, the retro, just to reemphasize, retro means all 3 years will be under the current standard, the new standard rather, whereas modified retro would be 18 will be on the new, and 17 and 16 will be on the old. But you have to mention the changes in the footnotes, so you got to have captured this information anyway. And second, words of wisdom, private companies, they still think it's years away when it's literally 1 year away. So I've been helping a lot of companies in the transition phase for private companies. And the second big mistake in industry is they believe that there's no change. They think that current guidance, we just roll it over. We're a private company, it doesn't apply to us. But I think it's a perfect opportunity to revisit. And if you're okay, you're okay. But more often than not, they feel that they need more work in the area of revenue recognition.
Well, thank you, Cecil. And George, what would you add?
I would just emphasize what my colleagues just pointed out before, and I would just reemphasize the fact that the time is running out. Speaking for the non-public companies, you have an additional year to adopt this standard. Use the time wisely, because you're going to have the benefit of the public companies jumping in the pool before you, and you can see how the water is, how cold it is. So you have the benefit of looking at public company filings that have actually adopted this to see how they've utilized the retroactive method or the modified retroactive method. It's also called the cumulative effect method. How it's with the cumulative effect method, how it's affecting the retained earnings, the disclosure. So there's going to be a lot of beneficial information for non-public companies that you can you can benefit from. But it's not that far away. And also keep in mind that if you have a non-public company and you have comparative financial statements, you're going to include the 2018 financials as well as 2019 financials in that presentation. Even if you're using the cumulative effect method or the modified retroactive method, you're going to have to make a lot of calculations that you cannot afford to be doing at the last minute.
Thank you, George. And with that in mind, if we're considering that organizations do need to get up to speed quickly, what are the most effective ways CFOs can identify and then fill knowledge gaps within their finance teams to support compliance with the new standard? I'd like to first hear perspective from, return to you, George, and then Cecil.
Communication by far is going to be critical in getting this underway quickly and effectively. So the CFO has to make sure that the plan is communicated, as well as the objective and the strategy, and this is being done in an effective and timely manner. Make sure that everyone is executing the plan as designed, not going in the wrong direction. And someone is coordinating this process. A lot of this, I think, is going to fall on the shoulders of the CFO, making sure that it's going in the right direction and the people are following the way it should. Stay involved. This is not something you can divvy out to a number of people and come back months later. This is something that you need to stay on top of to make sure that the guidance is provided on a timely basis and it's continuous guidance, and that you're there also to give to deal with any feedback that comes. Identify any gaps in the process, and there will be as this plan goes into motion. There's going to be questions, there's going to be interruptions, and there's going to be areas where it just isn't working as smoothly as you like to. So that needs to be identified and dealt with, and revisit the guidance as need to. So if you need to go back and you may need to go back to go to the drawing board from time to time, don't hesitate to do so. With the right people, just to keep this thing going in the right direction.
Thank you very much, George. And then briefly, Cecil, what would you add, especially as it relates to following up on George's recommendations?
Yeah, here's how I look at it differently. I'm a practitioner, so I work with companies in implementing it. The U.S. side, I think they're pretty good. Most accountants, the framework is pretty good. So I would say one comment, there'll be enhanced reporting, especially in the footnotes. For IFRS companies, I work with them too. It is significant. They are not used to the reporting like we are used to in the U.S. So they have expanded disclosures. Their previous model of IFRS was pretty light, I would call it, compared to the current standard. So they have a lot of catching up to do, and they don't have complex sales transactions like bundle products and performance obligations, and quite a few of those complex sales transactions we do in the U.S. So they will have little more work to do. Rather, the U.S. side, I think we are significantly there, in my opinion.
Well, thank you very much, Cecil, in outlining the distinction, especially given your work with in the realm of IFRS. We're now going to pose the second of 3 polling questions. And our second polling question asks attendees to indicate the extent to which you agree with the statement. My finance team is collaborating effectively with IT, legal, human resources, and other teams, that is within your organization, to implement the new revenue recognition standard. You're welcome to select the radio button that corresponds to your answer and then click on the submit button so we can record your response. From top to bottom, the choices are strongly agree, disagree, strongly disagree, or I don't know. And again, after you select the radio button that corresponds to your answer, we do ask that you click on the submit button. And then this way we'll be able to record the extent to which you agree or disagree with the statement, my finance team is collaborating effectively with IT, legal, human resources, and other teams, once again, within your organizations to implement the new revenue recognition standard. We'll give you just a few more seconds to respond. We'll then reveal how you have responded and then continue our discussion. And what is clear is that among respondents, there is agreement, but not necessarily strong agreement. Indeed, majority at the very least agree, but it's a rather slim majority, and I would acknowledge that a very significant percentage, more than or roughly 28% at the very least disagree. And so this is a nice transition to our next question, which is asking our distinguished panel, how should finance and IT teams work together? We're going to start with IT and then other areas that would work with finance. But first, with IT, how should finance collaborate with IT to ensure that both maintain visibility into information their organizations must report to comply with the new standard? And what I would like to do is first hear from Leah in response to this question.
Yeah, thank you, Joe. So from my perspective, obviously, I would establish a PMO office. And what you also want to do as an organization, you want to make sure that both you have a key finance and key IT executive support and sponsorship. Mainly because this revenue standard, the implementation is not just an accounting project or just an IT project. So buy-in of both organizations is going to be of importance to be successful. On a project team level, what I have seen as best practices is really creating teams of combined finance and IT organizations that work collaboratively. And the reason for that is because both organizations need to understand, obviously, what the accounting requirements are, but as well, the accounting organization needs to understand what potential the system and data limitations are from implementing a certain accounting position. And what you will see that sometimes the accounting organization may have to tweak a little bit of their initial proposed accounting position on the new standard, simply because the system or data is not readily available or it is too expensive to implement it. Other thing that you would take, what I would say, what you should take in mind is, don't be surprised if you're during build and development phase, if from a system perspective, that you have to change your initial design because things do pop up when you're really into the weeds. And lastly, I would say see this as an opportunity for both the IT and finance organizations to work together and appreciate each other's capabilities. Because in the future, I'm expecting the standard to be evolved, and you probably have to make some changes going forward. And knowing each other's strengths will help you down the line with the future implementations. Back to you, Joe.
Thank you very much, Leah. I really appreciate your thoughts about collaboration between finance and IT and the notion of a project management office. In terms of additional thoughts, Cecil, I'd like to hear your perspective, and then George, especially as it relates to ensuring that IT and finance remain on the same page.
Yeah, I'll quickly comment on, I think Excel is the most powerful tool. Often when the system cannot generate the information you're looking for, you go default to Excel. But You got to gather the data, as I've said before. You will find data errors, and I am a practice person, so I will tell you, no matter how good your systems are, there may be a few pieces here and there that are missing that you will have to generate either through the system, your ERP system, or outside of the ERP system because it's required by the standard. So education and updates are absolutely critical. Second piece I'll bring out is business models have changed. So when I visit clients, they tell me, oh, we are in compliance, but when you dig through the standards, it's something different. And I said, did you revisit the 5 steps? And the business models have changed. You had a physical product, now you're on the web, and now you're doing some of the models or different channels of distribution, and it is really, really different. So my best suggestion, revisit your revenue recognition policies. And once you feel that you have a good handle, in other words, pretty much write your footnote in your accounting policy on revenue recognition, and that will give you good food for thought and identify some data gaps along the way.
Thank you, Cecil. And George, what would you add, especially when you talk about making sure that you have proper coordination between finance and IT?
Yeah, well, there could be a significant number of people involved in this process, running across various departments. And when we're talking about IT and finance, they need to be, the IT people need to make sure that not only are they generating reports for you, but these reports are very specific. There are specific data that has to be pulled together, and it may go back to 2016, 2017. So you may be working on a parallel system for now while you're developing the 2018 model, but it's critical that the CFO is very vigilant on the reports that are being generated by IT to make sure that that's what they're that those are reports that are going to be informative and tie into the actual data, not just tie into the actual data, but also are conforming to the standards, to the model that's been set up, to the blueprint, so to speak. And that's when I'm going back to saying, a number of people are working on this. We want to make sure that everybody's on the same page and everybody understands what the blueprint is, what the model is, and that we're all going in the same direction, so that in the end we wind up with financial reports that are informative and accurate and in conformity with the standard.
Thank you, George. I appreciate that. We're now going to talk about CFOs coordinating with a variety of other areas, sales, legal, human resources teams in particular, to ensure contracts and compensation plans pass muster. And what we're going to do now is transition over to Kristen, because there's a lot to talk about here. So Kristen, I'll give you the opportunity to elaborate specifically on legal, sales, and then human resources.
Sure. Thanks, Joe. And I think, a lot of times people think of a new accounting standard, and that's going to impact the typical kind of SEC reporting, the controllership's office, maybe investor relations in terms of communicating the change, FP&A. But this particular standard actually reaches even further than what would be typical in the financial reporting area. And it really takes into account 3 places that I'll talk a little bit about, and my other panelists can elaborate some. But legal, and in this way, the standard is really focused on what is the contract. And so obviously there's a legal contract that is usually bounding the 2 parties. And so we think about the enforceable rights and obligations in that contract. And so to determine that step 1, do we have a contract, it may require us to consult or talk with legal representatives. And the other place within the standard that I spend a lot of time thinking about whether or not we need some legal opinion is in the overtime versus point-in-time area. And one of the requirements there in order to achieve overtime is that you have a legally enforceable right to payment for your performance to date. And so again, we think about the contractual terms. And so legal is very important in terms of understanding the actual contracts that we're doing the accounting for. I'll transition to sales. Clearly, the sales organization is key to every company, and for them to understand the ramifications of either their negotiation style or their acceptance of certain contractual terms is critical in order to get the accounting correct. And so it's really important for them to be appropriately trained, that they have an understanding and an appreciation for some of the nuances. I also think this is a great opportunity for organizations to consider standardizing their contracts. So clearly, if there is a standard contract, then it's the evaluation process is much easier because we just need to do an evaluation of a single contract if that's the one that we use 1,000 times. But if we use 1,000 different kinds of contracts, then each one of those may have a slight nuance to it, which each salesperson will tell you is critical in that particular setting. But again, it does complicate the accounting. And then the last department, Joe, if you maybe switch to the next slide, is the human resources and compensation. And again, this is one of those areas where I don't think typically the financial reporting organization is thinking about changes here. But clearly the way revenue is generated has such a link to performance bonuses, commission schemes, and so thinking about how an organization has historically used those to attract and retain its professionals, but also the accounting implications of this. The standard obviously is a revenue standard, but it does have some cost guidance within it, which actually requires the capitalization of certain sales commissions, depending upon the structure of those and the payments that are linked to winning a contract. And so again, people are spending a fair amount of time looking at their compensation plans, both to get the accounting right, but also to understand how it's being used in order to incentivize their people. So I'll pause there and turn it back to you, Joe, or allow some of the other panelists to pile on here.
Oh, thank you very much, Kristen. I really appreciate your going in detail or covering in detail various aspects of organizations that need to really consider contracts, make sure they're knowledgeable about contracts. That certainly bears repeating. Just briefly, George, and then Cecil, I'd like to hear your perspectives as well, again, in relation to human resources, sales, and legal, and how finance collaborates with these particular areas with regard to the new revenue recognition standard.
Sure. Well, Cecil and Joe, as far as the working with the different departments, in developing the revenue recognition model, the CFO needs to look at, hopefully identifying a template that could be useful in different departments, and that template may be different for different departments. In identifying that template or templates that are going to be used, the best possible scenario would be if they could standardize it as much as possible. Where I say where possible, because in some cases it may not be, but where you can, and in some cases where it's not a complex revenue process, you can have a simple standardized model or template for recognizing the revenue and applying the standard to the actual accounting data. In some cases, you may have to customize that model, that template, and this is where you have to sort of look at the various departments and see how each department is going to be affected. Can you standardize a template, or do you need to modify or customize a template for various departments to get the results that you need in order to meet the standard?
Thank you, George. And then Cecil, briefly, what would you add regarding collaboration between finance, sales, legal, and human resources?
Very quickly, if it is accelerating revenue, everyone loves it. So if a salesperson, you tell the salesperson, oh, we went from period of time to point of time, so their commission is going to get accelerated, you'll have no problems. They'll buy you donuts the next day. I'm good. But if you tell someone, oh, by the way, this new standard has your revenue is going to be deferred. We went from point of time to period of time. now it's a hard sell, and HR or someone has to communicate to everyone that you're not going to get your commission in this month, it's going to be next month or the following month. That's a little harder conversation. So that would be my two. That's what I learned in practice. So I always defer to the CEO to give, or the HR to interact with everyone and give them the good news or the bad news.
Thank you, Cecil, especially as it relates to sales. Next question we want to ask our distinguished panel: what are the most significant obstacles CFOs and their organizations are likely to encounter with regard to complying with the new standards, and how can they overcome these obstacles? I would first like to hear perspective from you, Kristen.
Sure, and I think we've been alluding to this throughout, that the new revenue standard actually has quite a bit of complexity just in its understanding, and I think what it takes is a very strong depth of understanding of your business, and then you compare that against the new requirements. And only in that case can you kind of work through whether or not there's going to be a change for you. And so that complexity and that evaluation takes time. And obviously at this particular point in time, 60 days from the end of the year, time is not on our side in terms of having that and affording ourselves the appropriate and thoughtful opportunity. So I guess I would just continue to encourage our audience to make sure that they have that PMO set up, have their key individuals within each of the departments that are being affected engaged, and create some kind of a timeline with milestones that you can accomplish, and make sure that you are going to accomplish what you need to by your personal company's required date. Also, the outside of just the financial organization, so how can you motivate? Obviously, Cecil just explained to us the notion of if somebody's bonus is going to come earlier, that's an easier conversation to have. But, strategically, how does an organization think of this change within its business? Where does it impact? How are all of those individuals being notified, being made aware of the impending change, and then how is the whole organization brought together to ensure that they do it in a thoughtfully planned and organized way? I think that's really some of the keys here, is understanding that this isn't just the financial reporting group's responsibility. It's actually much broader than that, and that's why when we think about the PMO, it's led at a very senior level. I think we have mentioned the audit committee, but clearly the audit committee's engagement on the importance of this and the importance of getting this right within each company is absolutely critical.
Thank you very much, Kristen, and appreciate your highlighting these particular obstacles, complexity and implications beyond accounting. And then, George, I'd like to hear your perspective, and then Cecil as well with regard to obstacles that you've observed.
All right. Well, the first and foremost is going to be time, which is what we've been harping on since the beginning of this session. And time is running out. The hourglass is starting to the sand is running out in the hourglass. There's a limited amount of time to comply with the standard, and there's a significant amount of ground to cover to make sure that we comply on a timely basis. And we're doing it correctly, following the standard. The second is to consider is the complexity, that this is not going to be easy stuff to adopt and to effectively apply, for everyone, and for many people, it's going to be pretty involved. There's going to be a significant learning curve. This could involve large companies, small companies, public companies, non-public companies. The public companies generally have the resources to do this, and they've got the horsepower. The smaller companies don't always do. Small companies may have to reach out to consultants to help them navigate through the complexity of the standard and how it affects their company. So don't be afraid to reach out and or plan on reaching out to other people outside of the organization that may be able to help you navigate through this. And following that thought is to plan ahead. considering that the time factor, the complexity factor, planning is going to be very critical in this process, so that we're not left out in the cold, when it's too late and the standard's already arrived, and effective time is about us. So plan ahead, make sure you've coordinated with the right people, you've got the right people on board with the different departments, and that will serve you well.
Thank you, George. And then, Cecil, in your experience, what would you add? What would you say are the primary obstacles you've seen, and how does one overcome them?
I think time has passed real quick. I remember doing this session 3 or 4 years ago, and I thought, 18 was really far away. But here we are on the doorstep, right? And I've been teaching this course for the past 5 years, the new revenue recognition standard model. It's here, and it's around the corner. But I'd add 2 more things. I think you've got to get the CEO's attention and the CFO's attention so that they're really zeroed in with internal communication, internal memos, education coming from them. They really set the tone in any organization, and people will start paying attention. That would be my words of wisdom.
Thank you, Cecil and George and Kristen. Now, moving on to our next question, and I think this is absolutely key, is, we have the deadlines coming up. There will always be deadlines. There will always be changes to a standard. So how can organizations and CFOs in particular leverage their most recent experience with transitioning to the new standard in formalizing best practices throughout an organization to adapt the changes in revenue recognition rules going forward? What I'd like to do is first direct the question to, once again, George and Cecil, and then Leah, I would love to hear your perspective as it relates to business models. But first, once again, returning to George and Cecil.
Sure. The CFO is really going to be the catalyst in implementing the standard and the changes that are needed to get it on board, and it's going to fall on his or her shoulders to make sure that the changes are made as intended, and the results are showing that as far as once it's been implemented. On top of the knowledge of the standard, of being educated on the standard itself, from a technical standpoint, it would be beneficial for the CFO to look outside his door, her door, to see how it's being adapted by others within the industry, and this can be seen through communications with others, not necessarily competitors, but others in the industry, and maybe in networking groups that the CFO is a member of. That usually information that like this is easily shared, and because it really benefits everyone. But I think you're going to see, as we look at different industries, that each industry is going to start to develop its own industry standard in adopting the new revenue recognition standard, and that can, to some degree, set some precedents or set the bar where it's properly being adopted, that other companies can benefit from. So, look out. Don't just look within your own company. Look outside your company and see what others are doing, and see if it's beneficial as well.
Thank you, George. Cecil, what are your thoughts as far as using the experience of transitioning to the new standard as a perhaps blueprint for transitioning to subsequent changes to the standard?
Yeah, I think I would echo George's comments. The industry trade groups are really good with wrestling with situations. Outside consultants who are specialists in this industry also, but have a strong well of knowledge that you can go to. The FASB has put out a lot of good guidance. I would say I work with IFRS companies, and they really have challenges. See, we had industry practice guidelines for a long period and still do. But on that side, they did not have the benefit of this great knowledge and resource, so they have a bigger challenge than we in the U.S. have. So, but I think we'll come to the same conclusion. With a little concerted effort, we should be in the right place.
Thank you, Cecil. And then Leah, I know you had some thoughts as well regarding business models, and I wanted to hear your perspective as well.
Yeah, thank you. So from my perspective, I would say, as your organization is considering entering into new business models, and like my fellow panelists mentioned, make sure that you involve all the departments, such as accounting, IT, HR, legal, simply because this standard is a very principle-based, and you often have to make some significant judgment calls. And new business models can have a significant downstream impact on your systems or your organization. And what you kind of want to avoid is do again a mini, RevRec implementation when you you enter into new business models. So it's always good to hash through new business models with the different departments involved so that you know where your exposure are and can tweak it as you go. That's what I would say, to add to the conversation.
Well, thank you, Leah. And we're now ready to pose our last question to our distinguished panel. We'll pose it to all of you, and then we'll pose our third polling question to attendees. But our last question for our distinguished panel: what are the most important recommendations attendees ought to remember from our discussion? And I'd first like to direct this question to George and then Cecil, and then we will hear from Kristen and Leah as well. But first, George and then Cecil, what are your thoughts on what you would want attendees to remember from our discussion today?
The first is look at the clock. Make sure that you use the remaining time to make sure that everybody who's involved in this process is up to speed on not only the technical requirements but the practical implementation and intricacies that are involved in that. Everybody involved needs to understand how this standard is affecting the company. Some are going to have to be more technically involved than others, but people need to have as we spoke in other slides, many of the departments are going to be affected, and they need to have that understanding. And thirdly, develop a plan, develop the templates. Remember, the templates can either be, some of them can be standardized, but some of them are going to have to be customized depending on how it's impacted by the standard and how it conforms to the standard. So it won't be the same one for each transaction. And then the last is really just don't delay. Just get this thing started, get the right people involved, get it moving, and you will not regret that.
Thank you, George. And Cecil, what would you add to George's recommendations, at least in the context of what George has already mentioned?
No, I'd go back to the drawing board, go to the 5 elements, make sure you're compliant, dot your I's, cross your T's. Like I'm working with a few software companies, and they're still on the fence. Do we go this way or that? Luckily, they're private companies, so they have another year. But revenue recognition, they're taken aback by the changes, by the significance, and how does it apply to their company? Is it point of time or period of time? And they're just having a major debate on these issues. But you got to have it nailed down. And if you're a public company, you barely have a month and a half or 2. And for private companies, you have. But don't think it's a year. I would say it's you have to gather the information as we go along. But making those decisions are critical, and time is of essence in this whole thing.
Thank you, George and Cecil. And then Kristen and then Leah would love to hear your perspective as well, what you want attendees to come away from our discussion about revenue recognition.
Sure, maybe I'll go first, and Leah, you can add your thoughts. I feel like we are a little bit of a broken record, but time is of the essence, and so whatever your project plan, I think it's the time to commit to ensure that you've laid out some key milestones that you can benchmark your progress against and make sure that you will successfully as an organization accomplish this. And that's That's key. And I think also our notions about disclosure, don't underestimate. I know a number of folks are so focused on kind of, is this going to be a recognition and measurement change? Will revenue change? And there's a lot of work that goes into that assessment, but even after doing that, it's not complete. There's a disclosure responsibility. And that disclosure responsibility starts with this year-end reporting requirements in terms of compliance with SAB 74, but then very quickly, as I mentioned, moves into the first quarter if you're a public company and the requirements to pull the full annual package of disclosures together for that first quarter. Make sure you're engaging with your audit committee, that this is led from the very top of your organization as a key critical effort that the organization needs to accomplish. And then finally, internal controls. You know, clearly, even when numbers, your revenue balance change, the controls and effort that you undertake as an organization to accomplish that is likely to change in some respect. The new words, the control model versus risk and rewards, is going to have an impact somewhere in your organization. So make sure that you're being thoughtful about the processes that you put in place around it, involve all the departments that we've been talking about, and ensure that you've got that plan in place. Leah, I know you had a couple other thoughts there.
Yeah, thank you, Kristen. So what I'd like to add is, yeah, as we have mentioned before, this is this standard has significant implications on your organization. So don't underestimate the level of effort. I would also say, you know, proving out that you don't have material changes or certain positions are not material is not easy and can be time consuming. So don't underestimate that workload. And lastly, I would say, you know, when you consider future business models, please involve all the other organizations, because you would like to avoid a mini RevRec implementation like you're doing right now. That's it for me, Joe.
Thank you, Leah and Kristen and Cecil and George. Before we ultimately wrap up, I do want to first pose the third of our three polling questions. And our third of three polling question asks attendees to indicate the extent to which you agree with the statement. My organization has established best practices for adapting to changes to revenue recognition rules going forward. You are welcome to select the radio button that corresponds to your answer and then click on the submit button so we can record your response. As with our first two polling questions, the choices from top to bottom are strongly agree, agree, disagree, strongly disagree, or I don't know. And we do ask that you select the radio button that corresponds to your answer and then click on the submit button so we can record your response. What we will do is give you just a few more seconds to respond to the question that asks you to indicate the extent to which you agree with the statement, my organization has established best practices for adapting to changes to revenue recognition rules going forward. Give you just a few more seconds to respond. We'll then reveal how you have responded. And so far, what we can see at this point is that actually a minority agree. So what's really intriguing is a significant percentage, roughly 22% of respondents don't know. And actually, that's why you've joined us. And so this is a great opportunity to think about what your priorities are, whether you're a private or a public company implementing the new revenue recognition standard. So we appreciate your responding to this poll and other polls as well. I want to acknowledge we've received great questions from attendees. We may not have had the opportunity to address all questions from attendees. We'll plan to follow up on any remaining questions after this webcast. With that said, in addition to thanking our very distinguished panelists, whom I'll return to in just a moment, as well as attendees, we do want to thank the sponsor of our webcast, which is Workday. And so we're now displaying some information about the sponsor of our webcast. Once again, Workday. I would add also that this webcast will be available on demand later this week within the webcast section of CFO.com. At that point, you'll be able to view and listen to a streaming archive of our webcast, download a PDF document that comprises slides from our webcast, and if you've responded to all 3 polling questions during our live webcast, you will have the opportunity to retrieve your certificate if you're not able to do so now. Again, if you've answered all 3 polling questions during our live webcast, you'll be able to retrieve your certificate when this webcast is available on demand later this week within the webcast section of CFO.com. Also, I would note that at the very end of our webcast, we will invite attendees to complete an online feedback survey. The survey will appear in a separate browser window, which you will be able to view if you've turned off the pop-up blocker within your browser, and we always appreciate your feedback. Once again, I'm Joe Fleischer, moderator of our webcast, and on behalf of our very distinguished guests, Kristen Bauer of Deloitte, Leah Albeck of Deloitte, George Victor of Giambalvo Stalzer & Company, and Cecil Nazareth of IFRS Partners, we very much appreciate your joining us for our webcast, and indeed because it is Halloween, the CFO Playbook on Strategy, how to take the fear out of accelerating your company's transition to the new revenue recognition standard, brought to you by Argyle with support from the sponsor of our webcast, Workday. We thank you for your time, and we hope you enjoy the rest of your day.